Hello there and welcome. If you're saving for retirement in Canada, you've definitely come across the alphabet soup of RPPs and RRSPs. But do you really get the mechanics behind them? Especially the nitty-gritty rules about what you can contribute and when? Well, today we're going to demystify all of it. We're going to break it down so you can make every single dollar you save work as hard as possible for you. Here's the game plan for today. We'll start with the essentials, then we'll dive deep into RSPs. And after that, we'll tackle your personal RSSP. We're also going to talk about a really common and costly trap you absolutely want to avoid. And finally, we'll look at the big picture, your entire savings journey. All right, first things first, let's clear up the confusion between the two biggest players in Canadian retirement savings, the RPP and the RRSP. You know, the easiest way to think about this is pretty simple. An RRSP, that's the company plan. Your employer sponsors it, and usually you both chip in. It's a workplace benefit. The RRSP, on the other hand, that's your personal plan. You set it up, you control it, and you, or maybe your spouse, are the ones putting money into it. One's for the team, the other one's all you. Okay, let's zoom in on RPPs, because this is where things can get a little tricky. Especially when we start talking about making contributions for work you did years ago. It's a concept called past service, and it can be a bit of a head-scratcher. The best way to understand this stuff is always with an example. So I want you to meet Eric. He has this opportunity to seriously boost his future pension by buying back 10 years of service with his employer. This happens all the time, but the tax rules around it can be, well, let's just say they're not simple. So, what are we even talking about when we say past service contribution? It's basically a way to go back in time and get pension credit for work you've already done. It can be an incredibly powerful tool to supercharge your retirement nest egg. But like we're about to see with Eric, the rules for deducting these payments are very specific. Okay, let's walk through these numbers for Eric, because this is where people often get tripped up. The first part is easy. Any contribution for service from 1990 onward, whether it's for his current work or past service, is fully deductible right now. That's that $23,500. Simple. Now, here's where it gets a little funky. The service before 1990. For those pre-1990 years when he wasn't in the pension plan, he gets a special deduction, usually up to $3,500 a year. So he gets to deduct another $3,500 right now. But for the pre-1990 years when he was a contributor, he can't deduct any more for those right now. So his total deduction this year is the straightforward $23,500 plus that extra $3,500 for a grand total of $27,000. Now what about the leftover $22,000? Is it gone? Nope. It's not lost. He just has to carry it forward and deduct it in the years to come. So what's the bottom line for your RPP? Here it is. Current contributions and any past service after 1989, they're simple. You deduct them in the year you make them. But for that older pre-1990 service, you've got to watch out for those special annual limits. And the really good news is anything you can't deduct today isn't lost. You just carry it forward to lower your taxes in the future. All right, let's switch gears. Enough about the company plan for a minute. Let's talk about your plan, the Registered Retirement Savings Plan. This is where you are in the driver's seat, building your own nest egg. And the very first thing you need to know is the deadline. This is a big one. For the 2024 tax year, you have until March 3rd, 2025 to get your money in. Seriously, mark your calendars, set a reminder on your phone. This is one of the most important dates in personal finance. So the big question is always, how much can I actually put in? And the answer is your RSSP deduction limit. The best part? There's no guesswork needed. The CRA literally calculates this number for you and prints it right on your notice of assessment every year. That number is your personal contribution ceiling. Now listen up, because this is a huge strategic tip, and it comes straight from the CRA. You do not have to claim the deduction in the same year you make the contribution. Why does this matter so much? Well, let's say you expect to be in a much higher tax bracket in a couple of years. You can contribute now, let that money start growing tax-free, but save the actual tax deduction for a future year when it's going to save you way more money. It's an absolutely brilliant tax planning strategy. Here's another great strategy a lot of people use. Contributing to your spouse's or common law partner's RRSP. This can be a fantastic way to balance out your retirement incomes down the road, which can lead to big tax savings. But, and this is the key thing you have to remember, when you put money in their plan, it still uses up your deduction room. Okay, we've talked about all the good stuff. Now we need to talk about a major pitfall, something I call the overcontribution trap.
because as great as it is to contribute, putting in too much can lead to some really painful penalties.
So I want you to just pause and think for a second. Is there any chance you might have put too much into your RRSP at some point? It's a way more common mistake than you'd think, and the consequences, they're very real. And here is the consequence. The penalty is a tax of 1% per month on the amount you've overcontributed. Now, 1% a month doesn't sound terrible, right? Wrong. That's a 12% penalty per year. It's a guaranteed negative return that will eat away at your savings fast. So what does excess actually mean in the CRA's eyes? It's any amount that goes over your deduction limit. But there is a little bit of a silver lining here. The government gives everybody a lifetime buffer of $2,000. The penalty only kicks in on the amount that exceeds your limit by more than that $2,000. So how can you check this for yourself? It's actually a pretty simple process. First, add up all your contributions to date. Second, grab your latest notice of assessment and find your deduction limit. Third, add the $2,000 buffer to that limit. And finally, compare the two numbers. If your contributions are higher than your limit plus the buffer, then you've probably overcontributed and you'll need to take action, which usually means filing a special form called a T1 OVP. Now, if you do run the numbers and realize, oops, I made a mistake, don't panic. There is a way out. If you can show the CRA that it was a reasonable error and that you're taking steps to fix it, like pulling the extra money out, you can actually write to them and ask them to waive or cancel the penalty tax. All right, so we've covered the getting money in part of the equation, but what about the whole point of this exercise, actually getting money out in retirement? Let's look ahead. You know, your RRSP doesn't last forever. There's a hard stop. By the end of the year you turn 71, your RRSP has to be wound down. You can't put any more money into it. You have a few choices, but for most people, the go-to option is converting it into something called a registered retirement income fund, or a RRIF. The best way to think of an RRIF is like a big collection bucket for your retirement years. You can pour in everything you've saved in your RRSP, you can transfer lump sum payouts from company pension plans, and you can consolidate money from all sorts of other registered accounts. It's designed to bring everything together in one place to provide you with that steady income you'll need when you stop working. And that really brings us full circle. We started in the confusing world of contributions and deductions, we navigated through some complex rules, and we've ended up with a clear strategy for turning all that hard work into retirement income. Hopefully, you now feel like you have a much clearer map for your financial journey. So, I'm going to leave you with this final thought. The rules of the retirement savings game, they are complex, for sure, but they are absolutely knowable. The real question is, now that you're armed with this knowledge, what steps are you going to take to make sure you are maximizing every single dollar you set aside for your future?